into thinking he could call every move of the stock market, was confidently telling his followers to sell all stocks and prepare for a massacre, just as the 300-point upsurge was beginning. And unhappily for him, he never changed his tune. Equally discredited was the equally self-acclaimed James Dines, who liked to call himself the original gold bug, and who this year finally, belatedly, gave his much ballyhooed, once and for all, sell signal for gold, almost exactly at the moment that that metal reached its bottom. Perhaps they were both simply standing on their heads. But despite those and some other spectacular flops, this was a year when they were...
January 21. Our panelists are Eddie Brown, Frank Cappiello, and Julius Westheimer. Tonight's special guest is Representative Jack Kemp.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. In the mid-1960s, when Lyndon Johnson was president, a favorite Republican joke concerned the fellow who said, "They told me that if I voted for Barry Goldwater in 1964, we'd get a much bigger war in Vietnam. And by golly, I voted for him, and they were right." This week, it seemed, we were getting to the point where the reverse of that joke could be told by the Democrats. Under the updated 1980s version, the fellow would say, "They told me that if I voted for Jimmy Carter in 1980, we'd have huge government spending, hard economic times, and the biggest budget deficits in history. And by golly, I voted for him, and they were right." We may indeed be approaching a stage where the way to accomplish something in American life is to vote for the candidate who campaigns against it. What else are we to make of a week precisely halfway through Ronald Reagan's term when the Secretary of the Treasury of the man who first promised to balance the budget by 1983 now takes pride in promising us that the enormous deficits that will actually occur will be heroically held below $200 billion. Surely that has to be the least comforting political promise of 1983. Just stop for a minute and think what candidate Ronald Reagan would have had to say if Jimmy Carter's Treasury Secretary had been talking so airily about $200 billion deficits. And that wasn't the only economic role reversal of the week. There on the horizon was a highly unusual and genuinely bipartisan group led by no fewer than 5 former secretaries of the Treasury who were saying as politely as possible that Ronald Reagan, of all people, was a ridiculously big spender. The group declared that the nation's current fiscal course was, in its word, senseless. While deploring the likely results of the looming string of deficits, the group conspicuously avoided the currently fashionable alleged remedy in Washington, still higher individual or corporate income taxes, but called for slashing projected government spending in fiscal 1985 by more than $85 billion. Does anyone believe for a minute that Ronald Reagan out of office would not be enthusiastically whooping them on? The president, meanwhile, who has been backpedaling for months from his original firm image as a tax cutter, was talking about raising taxes, another $135 billion, if nothing else works. And he apparently was smiling on a so-called solution to Social Security's problems that consisted overwhelmingly of raising those spiraling taxes even faster. Arthur Laffer, where are you when we need you? And as the final turnabout, there was the spectacle of the man Jimmy Carter named chairman of the Federal Reserve Board, Paul Volcker, suggesting that it was tough for him to bring down interest rates when everybody else in Washington seemed to be so infatuated with red ink. This image of disarray and abandonment of basic economic goals was, predictably, more than enough to unsettle Wall Street, where any loud noise is usually enough to occasion a backflip. The stock market went through its worst week since October, amid gathering fears that interest rates might jiggle upward again and inflation reignite as a result of all the bipartisan politics as usual in Washington. And so tonight we'll try to get a different perspective on the Reagan presidency by talking not with those in Washington whose policies he now seems to be scuttling to accommodate, but with a man who appears to believe that he has kept the Reagan faith considerably better than Ronald Reagan, Congressman Jack Kemp. But first, let's take time out ourselves to survey the shattered nerves in Wall Street. And as the Dow Jones Industrial Average indicates, the roar of the present and future scarlet flood gushing from Washington drowned out the good news that consumer prices in recession-plagued 1982 had advanced by less than 4% for the first time in a decade. The Dow reversed after 4 straight weekly gains and yielded nearly 28 points to 1,052.98. And there was damage up and down the line of the broader composite indexes of the New York and American stock exchanges and the over-the-counter index. Nor were our elves enthralled. Their technical market index slipped 2 notches to a bearish -3. And the prices of gold and silver were both slightly less precious at week's end. If Washington and/or Wall Street don't steady their nerves quickly, this could be the first inflationary panic to occur even before the economic recovery. For as a string of further economic reports this week underlined, the 4th quarter of 1982 was an unmistakable bummer. Ed Brown, is this just a normal correction, or is the stock market losing faith?
I think the stock market, Lou, will be a much better performer this year than the bond market. Last year, the bond market did almost twice as well as the stock market. This year, I think the stock market will do much better, followed by bonds, least attractive returns, and cash equivalents.
Well, is the poorer performance of the bond market part of these inflationary fears we've been talking about?
I think that's right, but I think they're unfounded. I see very little chance of inflation really getting back up to any significant level from this point.
In normal past recoveries, by the time the stock market had been up for close to 6 months, as it has now, we were beginning to see unmistakable signs of recovery. Do you see them yet?
Yes, I think there are many indicators. For example, I talked to analysts, and especially in the electronics area, semiconductor companies are seeing very strong orders. Auto sales have picked up, and housing starts have picked up. So I think there are glimmers of hope.
Frank Cappiello, let's turn to you for some glimmers of whatever insight you can give us. I suppose after 4 weeks of moving up, the stock market's entitled to sell off, but it did so rather abruptly at the end of this week. Are you concerned about that?
I'm a little concerned, Lou, that the market has been so weak this week. At the same time, we've seen commodity prices go up over the past really 6 or 8 weeks. Platinum, gold, silver, particularly platinum, have been in strong uptrends. And that disturbs investors because they think, well, geez, you know, maybe somebody knows something, and that a year out we're going to see a reignition of inflation. But I share the same view that Eddie has. I don't think we're going to see inflation rear its ugly head for at least a year.
Of course, in this current era, the stock market tries to look farther and farther ahead.
Yeah.
And it clearly is not reacting unfavorably to lower inflation. It is reacting to the fear that inflation may come again, and when Paul Volcker speaks as he did this week, they get nettled. Mr. Volcker's record is not always for saying what he does, though, is it?
That's true. Today he said that you know, interest rates wouldn't come down very much further, but I think Wall Street understands that 80 to 85% of the interest rate move is now behind us, and that the next move in the stock market has to be based on earnings. And I think that's what we're waiting for, this transition period for earnings.
Would you expect to see interest rates move upward at this point?
No, I don't think if they move up, they'll just move up for a bit and then they'll slump down again because there's too much excess capacity out there, Lou. But there is a recovery underway. Durable good orders went through the roof in December, up 12%. So I think we are seeing signs of recovery.
Julius Westheimer, anything putting you through the roof these days?
Well, I'm still enthusiastic about what has happened to the stock market. I think we're all spoiled. I think we're taking for granted the fact that the market is up between 35 and 40% in less than 6 months, which is a tremendous rise. And I'm not at all discouraged about what happened this week, maybe 4 or 5% decline. But Lou, I do think for the short term, you're not going to see the market go through the roof unless we have one of two things, and maybe both of them. I don't think you're going to see the market skyrocket any further unless interest rates continue to come down or unless corporate earnings show some signs of moving up. We've had a tremendous rally, and I don't think we can expect this every few months.
Well, Frank, who is still at least moderately optimistic on the outlook for interest rates, does not expect them to go much further down immediately. Do you?
Well, I don't think they're going to move up very fast because I think the recession is deeper and more serious than most people think. I've heard all of the optimistic phrases out of Washington.
I didn't know most people didn't think it was terrible. Everything I read and see in the news is a very severe recession.
is a very severe recession. And I think we're in one. And as I say, I don't think interest rates are going to move up until the demand for money accelerates. And I don't think this is going to happen soon.
Even the market bellwether, IBM, of course, was badly hit today because it came in with earnings that the market thought were a little less than expected. So this market is clearly vulnerable to that kind of disappointment, isn't it?
There's no question that it's vulnerable with these high PEs that we're now witnessing.
In any event, gentlemen, it is time now for us to steady our viewers' nerves and fatten their pocketbooks. Ed Brown, how would you respond to George LaBeouf of Baltimore, who writes us as follows? When a corporation embarks on a takeover attempt of another corporation through a stock tender offer, how is a list of stockholders in the target corporation obtained? Is there any ruling that requires a company to furnish the names and addresses of its shareholders to a predatory purchaser? In doing so, it seems to me that this is analogous to a hunted animal posing in front of a hunter and saying, "Go ahead, shoot me."
Good question, very timely. There are both federal and state regulations on this matter. For example, under SEC Rule 14D5, the hunted company or the target company is required to provide a list of its shareholders or to mail the materials themselves. Many times companies pursue both avenues, state and federal rules, for various reasons. One important thing happened in December, and that is that the proration date was made equal to the expiration date. This will allow many more shareholders to participate.
All righty. Frank Cappiello, much has been written about the possible economic beneficiaries of the new 5-cent a gallon gasoline tax. Terry Denton of Glasgow, Kentucky, wonders whether there might be useful investments in construction equipment or paving companies, adding, if you will pardon the expression, "My portfolio is in disrepair. Please pave the way for investment potential in these areas for me." We've got to do something about these puns.
That's really bad, yes. Yeah, we've got to clean them up. Well, the gasoline tax increase has already been discounted on Wall Street. Any company that's going to benefit from paving equipment, road building material, or anything like that has already been bid up. So if you want to make money in this area, you have to buy your straw hats in January. Is that a good pun? No. Yeah. Okay. Buy your straw hats in January, and that means buying cement stocks, which are really the straw hats right now. They're busted. Not many people like them, but they will participate in road paving, and they will also participate in commercial construction. Okay?
And if you're wrong, we'll put you in cement. Julius Westheimer, two fast explanations, please, for Warren Kohlauer of Desert Hot Springs, California, who wants to know what is meant by cyclical stocks, and what are pink sheets?
Okay. Cyclical stocks, unlike growth stocks of blessed memory, are stocks of companies whose earnings rise and fall with the business cycle. That's why they're named that. These are the steel stocks, the railroad stocks, the oil stocks, the copper stocks. A lot of them are in the Dow Jones Industrial Average. They have not basically much to say for research or new products or anything like that. The pink sheets are something quite different. That is really a nickname for the National Daily Quotation Service. All brokerage firms subscribe to them. They have listings of every over-the-counter stock in it and the most recent bid and ask price. They were started in 1913, and the man to whom I talked said they originally came out on pink scrap paper, and we kept them that way so everyone could identify them.
See, I thought they were what you found in X-rated motels. Okay, if all your investment sheets are in the red, don't feel blue. We'll try to get you in the pink, too. Just send your most colorful questions along to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. And we'll try to help you find pots of gold at the end of that pastel rainbow. Now, before we meet tonight's special guest, who first gained fame as a professional football player, we thought it was an appropriate time to take a look at Reagan at halftime and check the record of the U.S. economy in winning one for the Gipper. At the kickoff of the current administration on January 20th, 1981, when Reagan started calling the signals, consumer prices had been increasing at an annual rate of 12.4%. Unemployment stood at 7.4%, and the nation's real growth had contracted slightly in the previous 12 months, a period when the federal budget deficit was $68 billion. The bank's prime interest rate was bumping up against 20%, and the Dow Jones Industrial Average closed on Inauguration Day at 971.84. A year later, at the end of what we might call the first quarter, inflation was down and unemployment up, with both at 8.9%. The real gross national product was still limping along, though not as badly as before, while the deficit was growing. The prime was lower, but so was the Dow. Yesterday at halftime, the fans had something to cheer about on inflation, but unemployment had thrown the nation for a loss. The economy itself and the deficit suffered even worse penalties. But interest rates were being blitzed, and there was a string of first downs for the stock market. Clearly, it's a mixed set of first-half statistics. For some halftime analysis of what lies ahead, let's go over now and meet tonight's special guest, Congressman Jack F. Kemp. Jack, welcome. We're delighted you could be with us.
Oh, Louis, thank you. Nice to meet you. Nice to see you.
Jack Kemp is the first guest on Wall Street Week ever to have been chosen most valuable player in the American Football League. A former All-AFL quarterback for the San Diego Chargers and the Buffalo Bills, Congressman Kemp now has the somewhat lonelier job of calling the signals for what is left of supply-side economics. Jack, of all American politicians, you are the most identified with what we have come to call supply-side economics. Yet there seems to be a growing consensus in the country that that idea has been tried and has been an abysmal failure. How do you feel about that?
Well, I think it's silly. Supply-side economics is really an attempt to put incentive into the economy for those who want to save and work and produce, and it is a idea that in part has been tried, that is fiscal policy, but monetary policy is also key. Inflation is a tax that's finally coming down. Interest rates are finally coming down, but I think the jury is still out, and we're going to have to wait. But as far as I'm concerned, it has not really been tried to the extent that it should be, and it will work, particularly in view of the fact that there's a vacuum on the left in terms of answers for this problem.
To what extent is the president to blame for the failure, as you see it, to try supply-side economics?
Well, as I said before, I think the major problem that's occurred in the first 2 years of the president's administration is that there's been undue focus solely on fiscal policy to the exclusion of what type of a monetary policy could give us a long-term bond market and interest rates at single-digit levels. And as you pointed out in your halftime report on President Reagan, he came into office with 13.5% inflation and double-digit interest rates. The federal funds rate had been at 16% for almost 3 years. And I think the recession really began before Ronald Reagan took office. It began in auto, housing, steel, and agriculture back there in 1979 when the Fed decided to fight inflation by doubling the federal funds rate and the discount rate.
Well, I know you've been critical of the Fed, but let's stay with fiscal policy for a moment, because that's been the emphasis. The Kemp-Roth tax cuts were certainly an area of fiscal policy. In retrospect, don't you think it would have been helpful to put more emphasis on the need for spending cuts as well as tax cuts?
Well, there was spending cuts. The president has a good record, and I think the Congress went along in a broad consensus with the president that there had to be restraint. The major focus of the recession today has been the resultant deficit. In other words, it's been the recession that caused the deficit. Spending as a percent of gross national product went up from 21.9% to 24.9% because of the recession.
Do you know any economist who thinks that even in the recovery phase we're going to have a balanced budget?
Well, it depends on how long you'd be to get a balanced budget.
How long do you think it would be? Name any year that we might have a balanced budget.
Well, I think the balanced budget is not the sole goal of economic policy. The goal of economic policy is to bring unemployment down, expand the economy, and to keep prices stable. So
are you not worried about the deficits then?
I'm worried about it, and that isn't to say that I think the deficits are benign or that they're good. They are a symptom, however, of the problem. The problem is that for about 8 to 9 years in 1970s, we had almost double-digit inflation, which actually became double-digit inflation, and a steeply progressive tax code that had to be repaired if people were to get rewards again for their labor and their capital. And the president has made, I think, remarkable progress on restructuring the personal income tax code, and he's standing tall and tough on that issue. Now the issue in 1983, I think, has to focus on monetary policy so we can rebuild not only our domestic system of stable prices, but lead towards a world in which we can have trade and more stable exchange rates and a healthier balance of trade.
You've just praised the president, but he truly has abandoned you in the last 6 months. He's going for tax increases. Hasn't that been damaging to your program?
The president has gone for tax increases, and you label them right. They're not revenue enhancers. They are tax increases, and I opposed him. But I think he is also, he deserves high marks for maintaining the basic thrust of lowering the personal tax rates. We got the capital gains rate down. We brought the 70% rate down to 50. We stopped the double overtaxation of savings, and we have retroactively indexed the brackets, and indexing will take place in 1984. So those are, I think, healthy, and he is now talking about going towards even lower tax rates in the future. So those are, he deserves credit for that, and I
Do you and the president
respect
still
his
talk
efforts.
about tax cuts?
Pardon me?
Do you and the president still talk about tax cuts?
Yeah.
We know
I
what you
talk
say.
more
What-
about him than anybody else.
What does he say?
Well, as I said before, right now they're floating the idea of a flat tax. I wish it were more than just floating balloons. I wish it were serious. I think we ought to take the top rate down to about 15 or 20 and the bottom rate down to 4 or 5 on the poor, and change the holding period on capital gains and stop double taxation of dividends. And that, coupled with stopping the tax of inflation, I think would give this country a tremendous boom in the 1980s.
I think most of our audience would applaud your tax program. How many other congressmen do you think would vote for it?
Well, I'd rather have the people with me, because in the long run, we still have a democracy, and there are elections every 2 years. And I saw where Bob Dole and Barbara Conable the other day came out very strongly against a surtax in 1986. That was something that I certainly agreed with, and I was glad to see them do it. It didn't work for Lyndon Johnson, and I don't think it would work for Ronald Reagan. So there is a consensus in this country towards lower tax rates, and I think the problems of 1982 at TEFRA were a mistake. But again, and I sound like redundant here, but I really feel like monetary policy, or the lack thereof, is overshadowing fiscal policy, and that is the keynote of 1983.
I've got to send in the special team now, starting with Ed Brown.
Jack, I have a two-part question. One, economic, part one. You have been a critic of the Fed, as Lou pointed out. What reforms would you institute? What's wrong? Number two, there's a segment of the population, mainly the poor, the disadvantaged, that are really in human misery. Do you think that this administration has abandoned that group?
Let me take the second first, because I think the second part of your question is equally important to as the first. You can't help America's poor by making America poor. And America, as a nation, was becoming quite poor in the 1970s with inflation and overtaxation of income and savings and investment. The president has made a significant attempt to reverse that policy. He has not succeeded to the extent that we've gotten unemployment down. That is certainly the key to the final part. Not quite the final part, because I think we need to go further, and that is enterprise zones and reestablishing the role of entrepreneurial capitalism in the inner city as a way of creating jobs and social and economic opportunity. But the president deeply cares about people, and he is committed to making this work, and I think that some of our friends on the left side of the aisle have a lot to answer for to what they did to the poor, particularly in the 1970s. And motives are easy to challenge, but I think the president deeply, deeply cares about that goal. Secondly, in terms of the first part of your question, I would strongly agree with the Wall Street Journal lead editorial this morning, in which they said that the Fed has been right in abandoning monetarism. What they need to do now is to stabilize prices, and to, in order to stabilize prices, peg the price of gold at from 450 to 500, and begin to use a monetary standard around which we can build some order and some confidence and some long-term credibility into our financial markets, so that interest rates can come down and we can continue this bond and equity market rally. That would be very healthy for this country.
Jack, you seem to be saying that really Volcker is not the kind of Federal Reserve chairman that the president should have. And it's been suggested that maybe the president ought to have the chairman that he wants. In other words, instead of having the Federal Reserve separated, have the Federal Reserve like a cabinet appointment. Would you favor that, so that the president can get his Federal Reserve chairman?
I don't think it's, well, he could, because in August of this year he gets a chance to reappoint.
Yeah.
No, it isn't too late. He could make a change if he wanted to. Frank, I believe that Mr. Volcker basically has the credibility now if he not only continues his program of trying to target not just the narrow M's, but starts to target a P or a price rule, looks at the economy, helps to stabilize the international monetary system. I would say I would favor reappointing Paul Volcker. The jury's out, however, and I must admit I was a little disappointed today that he seems to be talking about moving back towards tight money, moving
West
towards
DM before time runs out.
and being so overly concerned about that deficit. I think that's a mistake.
I'm a little guy. I'm not a football player. I might get trampled if you don't give me a minute. You said a few minutes ago the jury is still out on Reaganomics. I know that you're not the president, but you're close to the president. You're identified with Reaganomics. How long will the administration stay with an obvious failed program of record high employment, low factory utilization, record bankruptcies, before there's some shift in direction to get the country moving again?
I heard you say a few minutes ago that you were moderately optimistic, that you saw that the stock market had risen by $300 to $400 billion, that there had been a bond rally. Commodity prices, I think Frank said, were coming back. Durable goods had picked up, and that housing, autos are starting to turn around, that there is some hope. It is not a failed policy. I reject your premise. It's a false premise, and it's one that assumes that somehow, if we'd have continued on the path that we were on in 1978 and 79, that somehow those problems would have been cured.
I have to stop you right there, Jack, because we're out of time. You've certainly been at least as kind to the president's economic ideas as he has been to yours. Thanks for joining us. Thanks to the panel. Hope you'll be back with us again next week. We'll try to find out then some things to do before the tax man cometh. My guest will be a leading authority on tax shelters, Robert Stanger, and we'll be asking him for the best new, smart, and legal ways of giving a little less to Uncle Sam. So if that sounds like a good idea to you, come shelter with us.
Cash out your soybeans at today's price level, you have no
Rukeyser.
opportunity to gain whatever this market might
This is Wall Street
offer you
Week.
down the road.
Welcome back. And don't you feel a bit uncomfortable? You look perfectly swell just the way you are, even if you did come slightly underdressed for such an elegant occasion. We, of course, are all duded up as part of our continuing, if still rather fruitless, attempt to inject a little class into American television, to celebrate our 13th annual Wall Street Week New Year's Eve party. This is the night when we look back on the economic year that was, and then in the company of some of our most expert panelists, look ahead to what reasonably might happen in 1983, and in the spirit of charity for all, how you can most effectively make a buck out of it. And what a year it has been. While the economy has staggered under the withdrawal pains following its prolonged binge of inflation, the financial markets sensed a happier run ahead. The result was the best rally in half a century in the stock market, on a record volume of trading and at record high prices, and as interest rates declined, an equally impressive advance in the bond market. Nonetheless, the year did have some prodigious losers. Joseph Granville, who had fooled some people, possibly including himself, into thinking he could call every move of the stock market, was confidently telling his followers to sell all stocks and prepare for a massacre, just as the 300-point upsurge was beginning. And unhappily for him, he never changed his tune. Equally discredited was the equally self-acclaimed James Dines, who liked to call himself the original gold bug, and who this year finally, belatedly, gave his much ballyhooed, once and for all, sell signal for gold, almost exactly at the moment that that metal reached its bottom. Perhaps they were both simply standing on their heads. But despite those and some other spectacular flops, this was a year when there were investment winners all over the lot. Stocks, bonds, gold, silver, mutual funds, and of course our Wall Street Week panelists, who turned in still another remarkable year. You know, I kid those fellas so much for not being perfect in their forecasts, which incidentally nobody is, that people sometimes forget just how outstanding they really are. A year ago, for example, 16 of our panelists dared the riskiest forecast of all, the high and low for the Dow Jones Industrials in 1982. As usual, some were too optimistic and some were too pessimistic, but the average was terrific. The consensus was that the Dow would reach 1,026, which was on the modest side since it actually went to 1,070, while the consensus panel forecast for the year's low, 791, missed the actual low, almost incredibly, by only 14 points. For years, millions of Americans have regarded us as the most valuable source of investment advice around. And while, as I frequently point out, nobody bats 1,000, the record for 1982 gives our panelists reason for justifiable pride. In the critical area of specific investment suggestions, Each of the 16 gave lists last winter that then had to stand untouched all through the year with no opportunity to take a profit or sell a loser. After the close today, Shaw Data Services computed those final records for us. 15 of the 16 lists were up, most of them hugely, and indeed 13 of the 16 managed to beat every one of the major stock averages. So fast was our track indeed that Marty Zweig, who recently has been hailed by outsiders for having the best newsletter stock selections for the last 2 years, could finish no better than in a tie for 8th among Wall Street Week panelists. So tonight, with high hopes, but of course no guarantees, we'll see if they can do it again. But first, let's see how the market ended 1982. The Dow Jones Industrial Average began the week at a new all-time high, 1,070.55. But when the broader market failed to follow suit, meandered trendlessly in the slowest trading since August. For the week, the Dow managed a tiny 1.5 gain to 1,046.54. The New York Stock Exchange and over-the-counter composites also eked out small year-end advances, but the real action was on the energy-heavy Amex, which had been the year's weakest performer. Not so the Elves, whose technical market index, correctly strong earlier, is now a mildly bearish -2. Time magazine may think the computer was man of the year, but my vote is for the little fellows. There was little enough to get excited about in the economy this week, with personal income rising weekly, the country's trade deficit moving toward another record, and one major bank, but only one, taking its prime interest rate down to 11%. Bob Stovall, many think the market's action next week will be terribly significant, the first days of a new year. Do you agree with that?
I don't know if I do or not. This last year, the January barometer didn't work. January was a down month, and there was a strong market year, as we all know. There's certainly going to be more than usual attention paid to the first week because people think that a lot of individuals will be selling the winners of 1982, and they just want to watch and see how the market takes that selling.
What's your guess about the market's next direction?
I think the market is due for a move downward. Interest rates backing up the way they have, moving higher again, is probably the #1 reason why I think is probably a pretty good time to look to taking some profit.
Mm-hmm. The market did set a new high this week, but it didn't set a new high for most stocks.
No, the market set a very narrow new high with the most of the action in the blue chips and the large Dow Jones stocks. It's disturbingly reminiscent to me of the November 1980, January 1981 period when the oil stocks were making their final high. Then they rolled over, if you recall, in early 1981 was a difficult time for the market.
Bob Nurok, we have to treat you and your elves with greater respect after their call of this big rally this year. They're mildly bearish now. Is that the way you are yourself?
Not really. I think that there are all kinds of little nuances in interpreting the index. And at this juncture, I think essentially I would regard the index as neutral. I'm a little bit more positive than that because I think the market is going to turn stronger before it suffers any severe reaction.
Well, Bob Stovall just told us it won't. Is it possible that you two disagree?
I think it is very possible. In fact, it sounds like we disagree at this juncture. I think the market's going to try to go up next week. It may falter a little bit at first, but then I think it will start to move up strongly. We'll then have a mini reaction sometime in the middle of January, and I think we're going to end very strong in January.
Historically, the first few days of January are usually pretty good, aren't they?
Theoretically, yes, but last year, for example, the first 3 days of January were very poor, as Bob mentioned the January barometer before. And so consequently, I'm not sure if it's going to be meaningful even this year.
Well, Frank Cappiello, I've got one vote to sell and be cautious and one vote to buy more because it's going to be terrific. Would you resolve this for us?
Well, I'd resolve it by saying if you're invested, you should stay with it. If you're not invested, you might be able to buy on a dip sometime in January, but the course of the market is
I once
higher.
had a broker who was a dip.
Don't look at me, Lou. But I think, you know, the market is going to win no matter what happens in the economy. If the economy softens and we don't get the kind of recovery people expect, interest rates will fall even further. That'll fuel the market. If we do get a recovery, interest rates may harden a bit, but corporate profits will start to get strong. So I think we're going to win either way in 1983.
Carter Randall, Bob Stovall mentioned that this situation to him seemed akin to the time the energy stocks were peaking out. I'm not so interested in that just now as I am in the fact that the energy stocks are picking up again. Do you have any comment on that?
Very interesting. Yes, Lou, there's a lot of speculation over what energy prices might do in 1983, and I think the consensus is that crude oil prices will go down more. But the energy stocks are very, very cheap statistically. The dividends are good, and I think there's bottom fishing in the market for those stocks. I think they're good holds almost as bond substitutes.
How about this question I've asked the others about where we are in terms of the market movement at this point? What would your assessment be?
Well, I think we're in the beginning of an economic recovery, and I think looking at this market is going to not only reflect the economic recovery, but the boom that lies ahead of that. We'll talk about that later.
All righty. Now, before we do ask these sages to gaze into their crystal balls, let's start with what we know for sure, as the Valley girls say. Oh, my God. The record of how major stock indexes performed in 1982. And the answer is quite beautifully, thank you. The Dow Jones Industrial Average, which closed 1981 at 875 and dipped nearly 100 points lower this past August, finished the year with a resounding net gain of more than 170 points, or nearly 20%. As is normal in the early stages of a bull market, the big blue chips in the Dow led the way, though the broader composite indexes of the New York and American stock exchanges and the over-the-counter market all finished comfortably on the plus side. So too did gold and silver, with the latter staging one of the year's most noteworthy comebacks. As for the economy, maybe the Chinese were right in calling 1982 the year of the dog. Turmoil from the Falklands to Lebanon and banking crises from Poland to Brazil ravaged the global economy this year, while at home, the U.S. economy often seemed like a beast with a split personality. The year ended with the country still mired in the worst recession since World War II, and the Reagan administration's predictions of a roaring recovery last spring seeming ever more hollow. Preliminary government figures now show the nation's total output of goods and services, its gross national product, declining both in the final quarter and for the entire year. But there was better than expected news on inflation. For the 12 months ending in November, the Consumer Price Index rose only 4.6%, as compared with 8.9% in 1981, and double digits the two previous years. The most conspicuous price of slowing the economy was rising unemployment. In November, it stood at a post-World War II high of 10.8%. Both the economy's slack and the lower inflation rate continued to bring interest rates down. The benchmark prime rate, stuck at 16.5% for the first half of the year, is 5 points lower now. And there were dramatic declines in long-term rates, too, which meant dramatic increases in the prices of bonds, which moved the opposite way from their yields. A year ago, the interest rate yield on the Standard & Poor's Composite Index of top-rated corporate bonds was about 14.5%. Now it's less than 11.25%. Still among the missing was the great Yankee trader. For the last 78 months in a row, the U.S. has imported more than it exported. Officials say the U.S. is likely to register a record trade deficit this year, and an even bigger one in 1983. And what else lies ahead? Well, one hopeful sign is the Commerce Department's index of so-called leading economic indicators. Its November increase was its 7th in the past 8 months, which should signal recovery, however sluggish, in 1983. Bob Stovall, the stock market clearly was more cheerful than the economy this year. How come?
The big news this last year has been the shrinkage of inflation and then the drop of interest rates, which the inflation shrinkage allowed. And by that doing, it sort of took all the zip out of the hard goods investments and alternative investments to stocks and bonds. When there was not much chance of profit in gold and real estate and diamonds and paintings and so on, people transferred their assets into stocks and bonds, not just here, but troubles abroad chased a lot of money into the States as well.
Why then did the gold price go up as well?
The gold price usually goes up during the early stages of a drop in inflation and drop in interest rates, because it makes it less expensive to carry gold. And I think as the year got older, people were frightened increasingly by this world banking situation where people don't seem to be bankrupt unless they can't borrow the interest anymore.
So less inflation plus a little scared.
Yes.
Bob Newrock, what do you think powered the market?
Well, I think it's even more simplistic than that. As a result of the conditions that Bob mentioned, I think that the...
Even more simple, perhaps.
Right.
Mr. Stovall's never simplistic.
I'm sorry. Both the stock and bond markets were really fueled by a tremendous buildup of liquidity as business demand for money declined and capital started to build up that had few alternative places to go. So it flowed into stocks and bonds, and this is typically what occurs in the early stages of a new bull market, and it doesn't matter what the economic background is, financial instruments then provide the highest possible returns.
Why are you so sure it's a new bull market? Why isn't it a rally in a bear market?
Well, I'm convinced primarily for the reason I've given, that we've had a tremendous buildup of liquidity, although the economy is only now beginning to show some few signs of turnaround. The liquidity that's available, which is in financial instruments now, is going to be available as business picks up further to turn the economy upwards, and then fundamentals will then begin to power the market.
What is this liquidity you keep talking about? Is that a New Year's Eve thing?
Probably it's very appropriate. Would just be the buildup of available cash for investment either in business or in financial instruments.
Frank Cappiello, what do you think? What made the market go?
Well, I don't think either answer is complete, because we've had the cash all during the spring and summer, early summer, and the market didn't go up. If you look at when the market went up, it went up in August. And in August is when Mexico got into trouble, when Brazil got into trouble, and Volcker, the czar of our money supply, decided that the fight of inflation had to be dropped. What we had to do was re-stimulate, rekindle the economy, our economy, to pull the other economies out. And that signaled the big stock market explosion, because people realized then that, my lord, interest rates are going to drop very fast and we are going to get liquidity. And that's when the big boom began. And the reason why this is a market and not just a rally is because we've never had this kind of move before. It's in 50 years.
What would it take to convince you that you're wrong? What could turn you around on that? I mean, is there any disaster that could strike that would change that view?
Yeah, let's say 5 or 6 upticks in the prime over the next couple of months. I'd get terrified. Any indication interest rates are starting to go up with some velocity, or alternatively perhaps Mexico or Brazil refusing to pay their debts, repudiating.
Dr. Randall, what do you think?
Well, I'm afraid I'm in the consensus here, Lou.
Then you know
I
you're
think
in trouble.
we're seeing a return of confidence. Confidence has been at a very low ebb. It is inching up, and I think it'll gain momentum as the economy recovers. And stocks are not high yet, statistically. Stocks and bonds are priced at about the same level as each other. If you take the capitalization of annual earnings on them, we haven't really seen an overpricing in the market yet.
Well, the Dow would have to triple, I suppose, to set a real all-time high.
Well, that's right. It'd have to triple to set a real all-time high, but if it could go up 50% without being too high.
So you won't be saying it's too high for quite some time, I guess.
That's right.
All righty, and now comes the moment when we hand out the prizes, grand and booby, to these fellas for their predictions exactly 1 year ago. And darn it, there's very little to embarrass them with this year. Bob Stovall, you led this quartet in picking both the high and the low for the Dow Jones Industrial Average in 1982. These three overguessed on the high, but your prediction of 1,025, which was almost exactly in the middle of all 16 panelists, was closest to the actual 1,070.55. On the low, your guess of 785 was only about 8 points away from the actual 776.92. You were too cautious in thinking the Dow would close the year 11 points below 1,000, but your recommended stock list was up by an average 44%, which in general should make you very pleased indeed tonight.
I'm working on my humility, Lou, but thank you very much.
Thank you. We will start lessons tomorrow morning. Okay. Bob Newrock, you were a double winner too. Among this year's New Year's Eve quartet, your Dow predictions were all a bit on the lofty side, but your year-ago forecast that the Dow would end the year at 1090 was the closest of the four. May I help you?
You sure can.
Are they having trouble hearing me?
Yeah, I can still go.
I'll shout a little louder for you folks west of Denver. Your Dow predictions, I say, were a little high, but your year-ago forecast that the Dow would end the year at 1090 was the closest of these four. And much more important, your stock list did the best of all four of these people. You were up a sparkling 46%. Please give an extra nip of New Year's brandy to the elves. A fine year. Frank Cappiello, you were nothing to sneer at either. While your Dow forecast was somewhat zany, your high prediction of 1,200 was the most optimistic and the farthest off of not just these 4, but all 16 panelists. When you stopped fooling around, though, and you gave us your stocks, you did just fine. If someone had bought them all and left them alone, he'd be 42% richer tonight. I hope you put your money where your mouth was a year ago.
That isn't chopped liver, Lou.
That's right. Carter Randall, any other year but this, you'd be sitting pretty. Like Frank, you were too rosy about the Dow. Your low prediction of 869 was the highest and the farthest off of all 16 panelists, but your stocks rose by fully 36%. This year, that was only good enough for 10th place. 10th place among our 16 panelists, though it did happen to be twice as good as most of the stock averages did.
I make no apology for 36%.
That's right. You also put us onto bonds early, which was very nice indeed. But enough of these hosannas. What have these 4 done for us lately? So tell us now, O great sages, the highest close, the lowest close, and the final close of the Dow Jones Industrial Average in 1983. Bob Stovall?
A roller coaster year, Lewis. A low all the way down to 920, a high of 1190, and a close at 1120.
An exciting year indeed. Bob Nurek?
A low of 968, Lou, a high of 1332, that's a pretty lofty high, and a close at 1294.
Wow. Frank Cappiello?
Yeah, I'm afraid Bob and I are very close. A high of 1330, a low of 985. I think the bottom's 990, really. And a close
Why'd you say 990?
No, 985. I got to have some leeway. And a close of 1210.
Okay. No decimals on that?
No.
Carter Randall?
Well, they're a little more optimistic than I am, but I'm optimistic. I say a low of 930, a high of 1220, and a close of 1200.
All righty, that all sounds pretty good. I'm sure that somehow, I don't know how, but somehow they're all going to be right. Like, I mean, for sure. In the past, the 4 New Year's Eve panelists have had to make their predictions instantly, while the other dozen could do so on their first appearance in the new year, which could be up to a month or 2 later. So this year, to make things fair and even for everybody, we've asked all our panelists to submit their Dow and stock predictions tonight. And we will, as a special feature, include every one of them in the transcript of tonight's program. So if you'd like to be among the first kids on your block to know what all our panelists like for 1983, just send $2 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. That's Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. And now let's see, with the usual cautions, disclaimers, and whistle blasts, what these 4 like. Bob Stovall?
I'm using 3 themes this year, Lewis. The first one is defensive, assuming interest rates keep dropping and consumer products do well. City Federal Savings and Loan, PepsiCo, SmithKline, Beckman, and Zondervan, the Bible religious goods company. Then 3 technology companies, Control Data, Quotron, Newport Corporation, and Safeguard Business Systems. And finally, at the end of the year, Rebuild America, Heavy Goods Rallying, Rearm America, Bethlehem Steel, which I think could be the best acting stock of the Dow 30, DuPont, Interpace, and Tenneco.
Thank you for your contribution to our financial rearmament. Bob Nurek, what do you and the elves like?
Because I'm very bullish and I think that stock selection will be the key. I'm emphasizing smaller companies that have the ability to improve their earnings, for which the price earnings multiple should expand radically, upward that is. Accuray, Dell Labs, Dynatech, S-Bay Manufacturing, First Executive Corp, Grand Auto, Kassler Corp, Key Company, Peabody International, RAI Research, Abe Schrader Corp, and Zydex.
Frank Cappiello, what do you like?
Lou, Phillips Petroleum, because of their find offshore California, International Minerals and Chemicals, Boeing, 2 banks, Texas American Bank shares, a Fort Worth bank, 2nd year in a row for me, First Columbia Financial, a small savings and loan, Warner Communication, a busted stock that will rise again, Caesar's World, ditto, Alaska Airlines, Charming Shops, a retailer, Chi-Chi's, a Mexican restaurant chain, the Browning of America, Aeroflex Labs, and United Television.
You seem to think people are going to have a lot of fun in 83, a lot of entertainment there.
Going to be a lot of travel, a lot of entertainment, a lot of fun. We'll end this year with bubbles and champagne.
Carter Randall, what's your list?
Lou, I've got some red chips as opposed to blue chips this year. Ametek, Archer Daniels, Centex, General Dynamics, International Paper, Ransburg, that's a repeat, Raytheon, Reeves Communication, and U.S. Home.
Incidentally, when you mentioned Raytheon, Frank mentioned Boeing, are you expecting the defense buildup that President Reagan wants, or the cut down that some other people seem to be calling for?
Well, my one reservation on that might be that we have some détente with Russia, but I still think we're going to have emphasis on defense spending through 1983. So I think the stock should do well.
Carter, you said something else interesting earlier on. You said you thought confidence was coming back.
Yes.
What are the signs of that at a time when everybody's talking about unemployment and recession?
Well, of course, there are polls on that subject of the consumer. The consumer confidence polls are a real clue as to confidence of investors, too. But also, watching consumer sales and the trends in them will reflect the confidence of people. And that's very, very important to the economy.
And finally and quickly, since you were so good on the bond market this past year, what do you think for 83?
I think we'll see continued decline in interest rates because we'll see continued decline in inflation, and we've got to see a narrowing. But I certainly don't see a repeat of the performance of bonds that we had in 1982.
So a good but not a historically great year.
That's right.
All righty. It should be a fascinating 12 months in which we find out whether they were right and just how much of what they said was as blazingly accurate as it turned out to be this past year. There we do have to stop. I want to thank my panelists for once again being such brave, good sports and for smiling under my lash. They're obviously gracious as well as smart. And I hope you'll be back with us again next week when we'll try to overcome everybody's communications problem. My guest, Stephen Krust, is Wall Street's top expert on what lies ahead for Ma Bell and for all her exciting new nephews, nieces, and neighbors. So don't forget to reach out and touch us. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night and have a happy.